and inclusion. Last week, for the first time ever, the IRS sent out the first round of advanced child tax credit payments. This is unprecedented. If you Google advanced child tax credits, there is an abundance of information, some accurate and some not so accurate. This led us to think further about our tax system and some of the notions we just blindly accept about it. Notions such as there is no white or black in the tax code, only green. It's just about the numbers, and they apply to everyone the same. But do they really? Today, our panelists will share their knowledge, perspective, and experience on various provisions of the tax code system to enlighten all of us that although it is true the IRS does not ask for or collect data on race or ethnicity, that does not mean that the tax system affects people of different races in the same way. But first, a quick housekeeping note. For our Zoom participants, you will have a chance later in the presentation to ask questions of our panelists. Please type your questions into the chat box so we can collect and address your questions in the second part of the program. Further, references for today's materials come from various sources, including Professor Dorothy Brown's book, The Whiteness of Wealth, and material published by the Tax Policy Center, Urban Institute, and Brookings Institute. Links to the resources will be emailed to you separately. We would like to thank all of our panelists for sharing their time and expertise with us here today, and the Community Foundation for their sponsorship. I'll now turn the program over to our moderator, tax attorney, and council member, Lisa Gallagher, who will introduce today's panel. Thank you.
Thank you, Judge Hill Harvey. It's my pleasure to introduce today's panel. First, we are joined by Mary Ellis Rosado. Ms. Rosado is a CPA, a JD, a LLM in tax, and is a senior international tax manager at Berkowitz Pollock and Brandt. She has more than 8 years of international tax experience assisting foreign and domestic high net worth individuals with their U.S. tax compliance and consulting needs. Her areas of specialty include international tax compliance and consulting for individuals, corporations, partnerships, and trust, international gift and estate tax compliance and consulting, pre-immigration tax planning, U.S. taxation of foreign trust and U.S. beneficiaries, IRS voluntary disclosure programs, and IRS international tax controversy issues. Ms. Rosado was born and raised in San Juan, Puerto Rico, and is admitted to practice of law in Florida and in the U.S. Tax Court. We also have with us today Ileana York. Ms. York holds a bachelor's in criminal justice, a master's in political science, a JD, and an LLM in taxation. Ms. York is an attorney at Barbosa Legal. Her practice includes tax controversy, international tax, succession planning, opportunity zones, and business law for domestic and foreign high net worth individuals. She represents clients with the IRS collection matters, such as delinquent taxes, federal and state tax audits, tax court litigation, notices of intent to levy, notices of federal tax lien filings, penalty and interest abatements, audit reconsideration, innocent spouse relief request, installment agreements, offers in compromise, and foreign asset and business reporting matters. Ms. York works with clients to advise and assist them with their pre-immigration planning, domestic and international reporting obligations, and asset protection. In addition, we also have with us Karen Russell. Ms. Russell represents the Internal Revenue Service at outreach and education events, working with tax professionals, industry, and small business owners. Ms. Russell has been employed with the IRS since 1986, spending 15 years at the Atlanta Service Center, working in examination, collection, quality assurance, underreporter, and criminal investigation. She relocated to South Florida in 2001 to work in the Taxpayer Assistance Centers in Fort Myers and West Palm Beach. In 2007, she accepted a position in Maryland as a tax analyst in the individual master file e-file branch and spent 2 years in HQ before accepting a liaison position in 2009. She regularly speaks at organization meetings, conferences, seminars, and workshops, both face-to-face and via webcast on tax-related topics. Thank you to all of our panelists for sharing your time and expertise with us here today. So the first topic to get us started is going to be with regard to marital status and the tax code. A quick historical note: when Congress first started taxing income, there was only one tax schedule. There were no distinctions based on relationship status. There was no head of household or married filing joint, married filing separately. That all changed in 1927 when a wealthy couple, Henry and Charlotte Seaborn, allocated 50% of Harry's income to Charlotte, thereby reducing their marginal tax rate and lowering their overall tax bill. Their case went all the way to the Supreme Court, and the Seaborns won, and thus paved the way for the joint filing status for married couples. Mary Ellis, can you tell us today about how marital status contributes to what is commonly referred to as the marriage penalty or the marriage bonus?
Absolutely. Well, first of all, I want to say hi, Lisa. Thank you for having me. It's a pleasure to be here. And yes, this is actually a very interesting situation. Like you said, before the Seaborns back in 1927, we didn't have different marriage or different filing statuses. It was just single, no married filing jointly, no married filing separate, no head of household. And this is important to point out because it's what contributes to what's a marriage bonus and what's a marriage penalty. Usually whatever your tax liability is, and it depends on your filing status. So if you look at the 1040 instructions and the tax tables, you'll see that there's different, the tax that you will pay will be calculated different and the rates will be different based on your filing status. Now, with that in mind, let's talk about what exactly is the marriage penalty and the marriage bonus. The marriage bonus is essentially a situation where two people, by filing together, end up paying less in taxes than they would pay overall if they were to pay separately. For example, married couple together pay $15,000 in taxes, just to say a number. But separately, maybe the one spouse would pay $20,000 and the other one wouldn't pay anything, but overall they'd be paying $20,000. So by filing together, they're paying less and they're getting a bonus. Obviously, the marriage penalty works the other way around. Married couple, again, would pay $15,000 together, but if they were to file separately, maybe each of them would pay $5,000. That adds to $10,000. So overall, they're paying less. And you wonder, how does this even happen? And it's precisely because we have different filing statuses. But what really drives that change is when you have different incomes in the household. So normally, you are more likely to get a marriage bonus if you have a household with one single earner, or perhaps one earner who earns 90% of the income and the other one earns 10% of the income. And then in situations where you're more likely to get the penalty is in situations where you have married couples that have more or less the same amount of income. And this is important, and this is where it comes in, the whole racial disparities. Nobody created this situation thinking, oh, I want to purposely hurt Black people or minorities. But normally, historically, where we see people that have similar dual earner families with similar income is precisely in Black households or even Latin families, not so much in married families. Of course, this, things change. It's maybe changing in the future as more women enter the workforce and things change. But historically, this has been detrimental to Black people. And the other thing that I wanted to say that I think is important is that this actually, one of the principles of tax policy is horizontal equity. And it's the idea that two families in the exact same scenario, like if they earn, say, one white family and one Black family, they both earn together $100,000, they should pay the same amount of taxes. But there's no true horizontal equity when you have one family where only one spouse works and another family where two spouses work, because it completely ignores the time that the non-working spouse has for other stuff. And the biggest thing that I can think of is childcare. If you have a situation where you have only one spouse working and the other one can take care of the kids, that's money that they're saving. So that you can't compare them to a couple that both work and then they have to use after tax dollars to pay for childcare. And there's other like cooking, cleaning, but childcare to me is like a big deal. And so there's another instance where you're thinking the tax code is meant to put two families in the exact same place, but they're not really in the exact same place. And oftentimes the people who get the worst of it tend to be Black people or people of color. So that's
the big points that I took is that if you have a household where you have one person is primarily the wage earner, the other person either has minimal income or no income, that family is more likely to get a marriage bonus. If you have a family where both spouses are earning about equally, that family as a tax unit is more likely to end up with a marriage penalty. And so the impact of that does flow into racial and ethnic discrepancies with how that's applied. So that's kind of really going to be a good liaison into our next topic, which I want to get to, which is into income disparity. Income discrepancy, salary, wages, and how that dovetails with retirement planning, because there's a lot in our tax code that deals with retirement planning, retirement assets, and how they're treated differently. So Ileana, real quickly, most people will understand our federal income tax system is a progressive system, meaning progressive tax systems mean that the more you earn, in theory, the more you pay. So I want to take a look at some ways where that just isn't true. Ileana, let's start generally. What can you tell us about income disparity, particularly in salary and wages?
Good afternoon, everyone. Thank you for joining us today. Well, salaries and wages are the largest sources of income for low and middle income taxpayers. In 2017, they constituted over 70% of the adjusted gross income for taxpayers with an adjusted gross income under $100,000, but less than 20% for those of an adjusted gross income of over $10 million. Wage disparities are particularly striking when comparing the earnings of women of color to those of white men. The median annual pay for a Black, Hispanic, or Native American woman working a full-time job is about 40 to 45% less than that of a white man. Asian, Black, and Hispanic people each have larger shares of full-time workers earning poverty-level wages than white taxpayers. Among all people with at least some income from wages and salaries, white and Asian people report higher averages than Black and Hispanic people. The share of white people reporting any wage income is somewhat lower since a larger share of retirees are white. Black workers are experience higher unemployment rates and lower wages than white workers at every education level since 2017. Between the years 2000 and 2018, even controlling for factors such as education, age, and geography, the wage gap between Black and white workers grew, while the wage gap between Hispanic and white workers remained fairly stable. In essence, the disparity in income, there continues to be a gap between white individuals and those races such as Black and Hispanic households.
So now that we have a general sense of how race can impact income, I want to specifically look at how the tax code can actually exacerbate that wealth gap. And I want to use retirement accounts as the vehicle to kind of do that. So Ileana, just generally, what advantages are there specifically to employer-sponsored retirement accounts in the tax code?
Well, retirement savings are a crucial vehicle of wealth accumulation for many American families. Contributions and earnings from assets and retirement plans are subject to preferential tax treatment. People with access to retirement plans or even with sufficient income to be able to contribute to these plans, can accumulate greater savings and the value of their assets grow effectively tax-free over their lifetime. Among private sector employees, workers of color are disproportionately represented among these without the workplace retirement plan. In 2016, for example, 60% of white families held retirement accounts compared with only 34% of Black families and 30% of Hispanic families. For families holding assets, the white to Black and white to Hispanic ratios in average value of retirement accounts have grown from twice to 3 times as high between 1989 and 2016. The federal government spends about $250 billion a year to encourage these retirement savings through tax subsidies. But these benefits primarily go to higher income families, with over 60% of the total benefits going to the top 20% of taxpayers by income. Black and Hispanic households are less likely to be among the highest income households, and they are therefore less likely to benefit.
So I think what we can show is we've got minority groups traditionally earning less income and therefore less able to participate in a retirement plan if it's even offered.
Yes.
And if it is offered, they can defer less of that income because they're making lower wages and the cost of living is, similar to everyone else. There may or may not be a match. And so they lose out on the ability to have part of their income deferred from taxation. But yet among the highest earning, the highest incomes, predominantly white earners, are better situated to be able to take advantage of employer-sponsored plans and defer more of their income from taxation. And
Right.
I don't think people realize when you get into really large numbers, how each year that compounds and compounds and it grows and it just increases the wealth gap. So retirement accounts are a big factor in discrepancy. In addition to retirement plans, Eliana, what other ways does the tax code benefit more affluent and predominantly white taxpayers? I think I heard you mention briefly, you touched upon that like 70% of the population relies on wages and earnings, but the top 30% are generating income from some other way, not salary and wages. So what are they doing and what benefits are there in the tax code for that passive income at the top?
Yep. So for starters, the more affluent and predominantly white taxpayers take advantage of capital gains. Capital gains are defined as profits from sales of capital assets, such as shares of stock, investments, business, real estate, land. Capital gains are taxed only when realized. This means when the underlying asset is actually sold. Unlike taxes on wages, the regular income for the lower income households, which are generally withheld as earned and must be paid annually, taxes on capital gains can be deferred, which means taxed later by not selling the asset. The preferential tax treatment of capital gains contributes to the growing disparity in wealth between white families and Black and Hispanic families. People with access to capital assets can benefit from preferential rates on assets held for more than 1 year before gains are actually realized. They can also benefit from the step up in basis provision, which effectively exempts income tax on unrealized gains on assets held until death. An example of this would be, I can hold real estate property for my entire life. And once I pass away, if I pass it on to my children, instead of them being taxed on the value of the property when I purchased it, let's say I purchased it for $100, and when they inherit this property, the value of the property is $500. Instead of them being taxed on that $400 difference, they get a step up in basis, which means that when they inherit that real property, the basis, which is the value of the property that they take on, is the fair market of that value when I pass away, which is $500. So now there's $400 of income, and that was a very small example of money that wasn't taxed. And that's an example of the step up in basis benefit that a lot of these white families are able to take advantage of and pass on generation through generation. So, for example, now this white family is able to start with that benefit, whereas a Black family that didn't have the same asset or any assets per se starts at zero. So to continue, white families hold almost every type of financial and non-financial asset at higher rates than others. Disparities in the value of corporate stocks and business equity, which generate a large share of the total net capital gains, are even wider. For example, in 2016, white families' holdings were 3 to 4 times higher in median value than those of Black and Hispanic families. According to the Tax Policy Center estimates, the top 1% of taxpayers by income who are disproportionately less likely to be in households of color received over 75% of the total benefits from the preferential treatment of qualified dividends and capital gains.
So we've talked about income for the sake of income, lower income rates. We've talked about the ability to defer tax on income by either being employed and having an employer-sponsored plan, being able to contribute pre-tax dollars to IRAs, if you're a SEP IRA, being able to do these different things. We've talked about capital gains treatment, tax at a lower rate. We briefly touched on qualified dividends. So with all of these different built-in mechanisms into the tax code, would you say, Ileana, that all income is taxed equally across racial and ethnic groups?
Absolutely not. And that's echoing off of Maria Ellis's last example, where you have two families, a white family and a Black or Hispanic family that make the exact kind of income. But you realize with her example how different this income is taxed. And something else Maria Ellis discussed in a previous conversation that we had regarding this town hall meeting is just how, with the example I just gave, how white families start with more chips in the game. For example, they have families that have over the years benefited from the tax code and from the benefits that the government has imposed, but it's not the Black and Hispanic families that are able to benefit from these programs, it's the white families. So no, the income is not taxed the same throughout all families.
That is a great lead in to our next big topic, which I want to address to Mary Ellis, and it's regarding home ownership and home ownership as a means to accumulate wealth. A quick historical note here. After the Great Depression and before the Fair Housing Act of 1968, there was a process called redlining. There's a link, or there will be a link in the email that is forwarded to everyone with some great articles on redlining. If you have never heard the term or you don't know what it is, you can just Google it. There's a lot of material out there on redlining. In essence, redlining was the process of the Federal Housing Administration refusing to insure mortgages in or near Black neighborhoods. So this basically meant that all of the housing development programs that were under the New Deal right after the Depression, all of the benefit of those programs basically went to white families. And I think that that's where you're saying, like, historically, minorities have not been set up with the system the way white families have been to kind of take advantage now of these different tax code provisions with capital assets, for example. So Mary Ellis, please share with us how home ownership can be an important step in accumulating wealth.
Yes, so actually owning a home, if you think about it, is the American dream. That's probably the biggest investment the average American is going to make in their life. And the idea is that despite temporary ups and downs in the market, we know the market can go crazy like right now.
Yeah.
The idea is that in the long term, your real property is going to appreciate in value. And so because it is such a big deal, the tax code actually incentivizes home ownership with various incentives. That was redundant, but yes. Basically, it's three. The first two have lost a little bit of importance after the tax reform of 2017, but they're still there and they still play a part. Basically, the first one is a mortgage interest deduction, which means that when you buy a home, you're able to deduct in your taxes the interest on the mortgage. That is limited if you have mortgages before 20 of more than $750,000, but still you're able to deduct some of the interest, if not for most people, most of the interest on your mortgage. The second thing is being able to take a property tax deduction, which again got limited with the new tax law, and you can't really deduct more than $10,000, and that's also combined with like state and local other type of taxes. But yes, but the biggest one, which hasn't changed and has been the biggest thing since like for the longest time, not changed by the new tax code, is the being able to exclude gain from the sale of your primary home. And basically the rule is that if you have a home and it has been your primary home and you have lived in it for 2 of the past 5 years, you are able to exclude from the gain up to $500,000 if you're married filing jointly, up to $250,000 if you're single. And any excess, if you happen to have an excess, which again, almost would be mainly really wealthy people, would be taxed at the lower capital gains rate that Ileana talked about. And it's important to point out, one, that these incentives actually cost the government a lot of money. A study showed that despite the limits from the 2017 tax law, from 2019 to 2022, these incentives are going to cost the government $280 billion in lost revenues. On top of that, I think it's important to note that despite these incentives throughout like time since they have been in place, there hasn't necessarily been an increase in home ownership that would lead you to believe that they really got people, oh, now I have an incentive, let me go buy a house. So they haven't necessarily worked. And what has come about is that it's normally the wealthy people who have benefited the most. They're able to buy bigger houses and deduct more. And one last thing is, on top of the limits of the new tax law, an additional limit is that the standard deduction increased. So usually you would take your property tax deduction and your mortgage interest deduction if a combination of those and a few other things like your medical expenses, charitable contributions are higher than your standard deduction. But with the increase in the standard deduction, it's really less and less people who take advantage of that. Yet you still have people taking advantage of that, and it tends to be the wealthier white people.
So that's a lot of provisions in the tax code that, for lack of a better term, are kind of sold to all of us in the average range as being benefits. And yet most of us actually get very little, if any, of the benefit from that. But I want to take it one step further. Now that we've got these three, how do these purported benefits actually play out for differing races and ethnicities? I mean, we talked about the most important one for most of us. I mean, I know that I'm not going to take the mortgage interest deduction. I'm not going to take itemize my property taxes. I mean, my standard deduction is higher and will be for the foreseeable future. So we're talking about this exclusion of gain is really the big one, except across differing races and ethnicities, not all neighborhoods are experiencing gain. So how does this actually play out in terms of widening the wealth gap? How do these provisions contribute to that, Mary Ellis?
Well, that's a great question. Well, first of all, like we talked about, I did my taxes. I did not get a benefit of the mortgage interest deduction or the property taxes. It just didn't work out that way. But I'm sure wealthy people can still take advantage of that and do their itemized deductions. But a big thing too is that first, despite these incentives, people are not more likely to own their home. And that's certainly true for everybody, but it's certainly true for Black people. They're less likely to own their homes. And for them, it's even less likely because precisely of the history of redlining and subprime mortgages given to Black people. It's just less likely that they're going to be able to achieve this American dream. But even those who do buy their homes, unfortunately, their homes do not tend to appreciate in value as much as the white homes. It's just a fact. A bunch of studies have been done about how if you buy a house in a white neighborhood, it's just going to appreciate so much more in value than the same type of property in a white neighborhood. And the interesting thing about that is that you could always tell Black people, well, just move to a white neighborhood if you want your house to appreciate. But again, studies show that it's because it's a white neighborhood that it appreciates. And if more than 10% of people in a neighborhood are Black, the neighborhood already starts going down in value. It's just amazing how that works out. And there's plenty of studies about this. It's just insane. But this also brings us to the whole homeownership exclusion that I talked about. So think about it for a second. Blacks are less likely to own their home. And once they own it, they're less likely to see that appreciation that could be tax-free, and that is tax-free for a bunch of white people. On top of that, like Ileana said, if they were to hold their home until death, the heirs would get a step up in basis, but the heirs are not going to get that huge step up in basis that white heirs in a white neighborhood would get, which is insane to me. And the worst part of all is that there are situations, it is more common than people realize, where houses in Black neighborhoods actually depreciate in value. And there is no corresponding loss that you can take on your tax return for selling your home at a loss. So while a lot of gain, especially for a white person, can escape taxation, you can't even use a loss to offset other income or anything. So again, it's interesting because these incentives, again, were created to, help everybody. But the way they play out culturally, historically, it just doesn't work the same way for Black families or Hispanic families or just other minorities.
So let's get back to this idea of horizontal equity in the tax code. So Mary Ellis, what do you think about the idea of building in horizontal equity? And as long as people are getting a mortgage interest deduction, giving some type of deduction for the payment of rent?
That's actually a good point. And I think there would be mainly two reasons why that doesn't really work out. The first one would probably be because the incentives that are in the tax code are precisely to incentivize people to own a home. To incentivize people to build a safety net, build some wealth. And if you're renting, well, you're not doing that. So the tax code is like, I don't need to incentivize you. You need to live, you need a roof. So sure, you're paying rent. That would probably be one reason. But I think the main reason is that a rent expense is considered kind of like a personal living expense that shouldn't be deductible. Like you take a personal loan, you can't deduct the interest. So this is considered also a personal thing. And the rationale behind that is people make different choices and the tax code shouldn't incentivize those. For example, I live in Miami. I could choose to rent a nice condo in Brickell, or I could choose to be more moderate and go to Kendall. And the tax code shouldn't give me a benefit because I chose to be fancier and go to Brickell than to Kendall. So that's the idea. Of course, in my opinion, this is flawed because if you're incentivizing home ownership, well, that's also a personal choice. Where you live is a personal choice. Let me go buy a bigger house and get a bigger benefit, which is precisely what happens.
Yeah.
Studies have shown that these incentives home ownership incentives haven't led to more home ownership, but they have led to people owning bigger, more expensive homes, which is kind of interesting.
Bigger debt. And touching upon bigger debt, that gets us to our next topic. So the next part of the tax code that I want to take a look at is higher education and student loan debt. Another quick historical reference. After World War II, Congress passed the Serviceman's Readjustment Act of 1944. This is known as the GI Bill. Many believe this was a great benefit to returning Black soldiers. The truth was that many were denied college entrance altogether, and if they were admitted, the Veterans Administration, which was supposed to be helping them, would often work with the higher education institution in steering the Black individual into areas of agriculture or technical work. It was the philosophy that education was solely for a Black person's economic advancement only, and there was no use in having a Black person obtain a liberal arts education. There's going to be a reference to a wonderful article on this topic, which will be included in the email following the program. So Ileana, people will say, and they like to believe, that higher education is the great equalizer. In your opinion, how does that position either ring true or false?
Well, the government has implemented certain incentives such as the American Opportunity Tax Credit and the Lifetime Loan Credit and other tax preferences that are aimed at increasing access to higher education and offering the rising cost of education. However, studies have shown that these subsidies have not significantly increased access to higher education among low-income families. Middle to upper income families, who are less likely to be families of color, receive the largest share of these benefits from direct higher education tax subsidies. Students of color are more likely to receive aid from need-based Pell Grants. Higher education enrollment rates have been similar among white, Black, and Hispanic students. However, of those seeking a bachelor's degree, white students are more likely than Black and Hispanic students to graduate within 6 years of starting their undergraduate program. Overall, Black and Hispanic students attain bachelor's degrees at lower rates than both white and Asian students. Higher education has positive effects on employment and income security, as well as the lifelong wealth building opportunities. Although the enrollment disparity in bachelor's degree programs has narrowed, attainment gaps between the white and Hispanic and Black students have widened since the 1990s.
A quick comment, all of this higher education expense, higher debt for education among minorities, either because there's no family support, there's no capital assets. We've talked about the lack of capital assets within minority families, nothing to sell to help fund higher education expenses for minorities, lower graduation rates, lower income upon graduation. All of this is contributing how in terms of really spreading the wealth gap?
It's contributing by, we're still having an increased student debt. At the end of your investment in education, you know, like Marieli said, this is another American dream. I come from an immigrant family. Both of my parents were immigrants. My family still lives in a third world country. The American dream is to come to America, own a home, have an education. I take a lot of pride in my education. And so one of the programs or another incentive that the government has implemented is the student loan interest deduction, which allows taxpayers with qualified student loans to reduce their taxable income by the amount of loan interest they paid during the year. But that's only up to $2,500. And only taxpayers with an adjusted gross income under $80,000, $165,000 for joint filers can use this deduction. So the deduction is of no benefit to low-income families with zero income tax liabilities. So it largely only benefits middle to high-income families.
Circling back to our first topic on the marriage, on marital status. If I'm married and I've got a student loan and my spouse has a student loan, do we each get the $2,500 student loan deduction?
This is, yeah, so per person, yeah.
Right. Moving on, I want to just quickly, because I want to get to the good news. There is good news in all of this. I just want to really quickly, would be remiss if we didn't talk about state and local taxes. Before, I mentioned that our federal income tax system is progressive, which in theory means the more you make, the more you pay. Well, we've already discussed some ways how you can actually make a ton more and pay less through capital gains, qualified dividends, other types of taxes on deferral. But I want to talk about state and local taxes, which are regressive. A regressive tax system means that the less you have, the more tax you pay as a percentage of what you have. So as you all know, Florida has no personal income tax. Florida relies on revenue from sales tax and property taxes. Florida's sales tax and property tax are both regressive tax systems. What that means is that the exact same tax rate for the exact same goods and all real property applies to both the poorest and the wealthiest equally. And there will also be an article from the Florida Policy Institute that will be included in the email with the resources. Finally, we are getting to our final topic, which is what I think is one of the great things that makes this discussion so timely, because payments were just sent out. I want to talk about the advanced child tax credit, which is the child tax credit, but then the fact that it's being advanced. And Karen, I'd like to thank you again for joining us here today on behalf of the Internal Revenue Service. These questions will all be directed to your attention. Can you first just quickly tell everyone, what is the child tax credit? Why am I hearing so much about it all of a sudden? And is it a new thing?
I sure can, and thank you so much for having me on today. So the child tax credit is for individuals who claim a child as a dependent if the child meets certain conditions. It is not a new thing, but the child tax credit has expanded recently because of the American Rescue Plan Act. And in previous years, it was $2,000 per qualifying child. There were earned income requirements and limited refundability.
And what's different this year?
A couple of things are different. So first of all, the maximum amount of the credit has increased to $3,600 per eligible child that's under the age of 6, and $3,000 per child between the ages of 6 and 17. Something else that changed too was the age of an eligible child. The credit includes children who turn age 17 in 2021. It used to be that the child had to be under age 17. And of course, there are conditions. I don't want to go into the whole thing. The information is on irs.gov about the conditions, who qualifies as a child, as a qualifying child in our FAQs. But I mean, it's like the son, daughter, stepchild, eligible foster child, things like that. The child does not provide more than half of his or her own support. And there were a couple of other things also that would make that child qualify. And then lastly, even if a person has zero income, they can receive the advanced child tax credit payments if they're eligible. And again, there are some qualifiers for that. You have to have a qualifying child. You and your spouse, if filing a joint return, have to have your main home in one of the 50 states or the District of Columbia for more than half of the year. And your main home can be a house, apartment, etc. It can also be temporary lodging for people that are experiencing homelessness. So that's a big thing.
So this year, we're not just calling it the child tax credit, we're calling it the advanced child tax credit, and it's all over the internet. People are getting checks in their accounts. What's the purpose of the advance?
So according to the legislation, Lisa, the purpose of the advance is to get a portion of the child tax credit out to eligible families from now, again, because they started July 15th, through December, rather than having these eligible individuals wait until 2022 to obtain the full credit when they file their 2021 tax return.
Gotcha. And can you tell us the different ways that taxpayers will receive this advanced child tax credit?
Yep, that's super easy. It's either going to be direct deposit or a paper check in the mail.
And you mentioned we touched on this prior. It used to be that there had to be an earned income requirement that is no longer. So what if I'm a non-filer? Do I still qualify for the payment?
Yes, you do. Of course, you have to meet eligibility requirements. But again, like we said, there's not an income requirement. If you're not required to file a tax return and typically do not file a tax return, we have an online tool called the Child Tax Credit Non-Filer Portal that can be used to provide the information necessary to the IRS so that we can send advance payments out.
So if I'm a non-filer, all I have to do is have internet access and someone to help show me how to go onto the IRS website to the portal and then just follow the steps. I mean, is the portal user friendly? Is it, put your name in, put your social security number, that kind of thing?
There are a couple of things about the portal. There's a person's going to have to verify that they are who they say they are. Mm-hmm. My understanding is the portal is easy to use. That's my understanding. A couple of people have used it that have provided feedback, and so and then we actually have. I believe I provided the link to you that you're going to send out, but we've got a step-by-step guide on how to use the non-filer tool. I believe that's publication 5538.
Perfect.
And so there's step-by-step guidance. It walks you right through it. It gives you screenshots and everything so that you can follow along as a person that is trying to sign up to receive this advance payment.
Is it your guess that, or your estimate that the child tax credit is not new? It's always been in the tax code. But for people who were non-filers, they didn't take advantage of it. They would have had previously to this year, they would have had to actually file a return, claim the credit to get the money back. Most non-filers wouldn't know about the child tax credit. So do you feel that this year that you're going to see a significant increase in this credit, these funds that have always been earmarked for this purpose, actually getting into the hands of the families that it was designed for?
Absolutely. As a matter of fact, we are doing a push to get information out about the advanced child tax credit, about the child tax credit regardless, because we do want people that are eligible for this money, for this credit, to know about it. Now, there are some caveats with this. These changes for the advanced child tax credit only apply to 2021.
Yeah.
And that is specifically on irs.gov on the child tax credit landing page. I believe I supplied that link that can be shared as well. But yeah, these changes apply to tax year 2021 only.
Is there any discussion internally about the likelihood that this will continue to 2022?
I'm outside of that loop, so
Yeah.
I am not sure if an extension is being discussed or anything like that.
Well, this would be one of those great things. Hopefully, at the end of this tax year, we'll get some statistics back on how many people were non-filers who actually did go through the portal and were able to access this. We'll see if whether or not this really was an efficient way to getting, earmarked funds actually into the hands of the people that it was legislated for. Real quickly, if someone qualifies and doesn't want the advanced child tax credit, maybe they think that in the end, they're going to have a tax liability and they'd rather not have to pay it back. Is there anything that they can do to opt out?
Which is a perfect reason for them to opt out, by the way. Yes, there is the Child Tax Credit Update Portal. will allow someone to unenroll from receiving the advanced child tax credit payments. And again, there are several reasons that somebody might want to do that. If they expect that they're going to owe tax and it's greater than the expected refund when they file their 2021 tax return in 2022, that might be a reason. If they want to receive all of their child tax credit at once instead of receiving the advance payment, that's another reason that somebody might want to opt out. And then because these advance credits are, well, because the credit is paid in advance, every dollar that someone receives this year will reduce the amount of child tax credit they can claim on their 2021 tax return.
Got it.
That those could all be reasons to unenroll.
Okay.
Okay.
Okay, it's time now to take some questions from our audience. And Elias Seg, do you have any questions, or do you want me to ask one or two that I might have?
Judge, I think you're actually up.
Okay, great. I have two questions. One is, what is the site for the home tax code or publication for the incentives for the mortgage interest and the like? And then the second one would be, are there any in the advanced child tax credit, is there any benefit for disabled adults?
I can answer. Well, the incentive for the home ownership exclusion, that's Internal Revenue Code section 121. I don't know off the top of my head the mortgage interest deduction one, but I can probably find out quick.
Okay, our last panelist could be able to tell me that because she talked about the advanced child tax credit. So is there anything for the disabled adults?
The advanced child tax credit are for children under the age of 6. That's the increased value of the child tax credit, and then between ages of 6 and 17.
Okay. Are there anything for the disabled adults that a person may be filing for that's responsible? A parent.
I would actually have to do a little research on that. I believe there is a credit for, and I can't think of it off the top of my head, credit for just permanent and totally disabled, but I cannot think of the form number off the top of my head, and I believe, there are requirements to qualify for that credit.
I can get that to you, Judge. It's not in the child tax credit.
Okay, thank you. Okay, Elias, anybody else have any questions?
No more questions.
Oh. Okay, we hope you found today's panel discussion informative. For those of you looking for volunteer opportunities, you can reach out to Suncoast Vista, which stands for Volunteer Income Tax Assistance, and help families register through the IRS portal for the Advanced Child Tax Credit. The Sarasota County Bar Association would like to thank our panelists for their thoughts and perspective. We'll post a link to this video to the Sarasota County Bar Association Facebook page, and we will have it available for viewing on the Sarasota County Bar Association YouTube channel. Don't forget to like and share with friends and colleagues on your preferred social media channels. And thank you again today for watching.